in close collaboration with our partner TOBAM. As you all know, TOBAM's investment philosophy consists in maximizing diversification in order to collect the risk premium of an asset class. So it's obvious why we are delighted to have them with us today to talk about concentration and its impact on alpha. Our speakers today are Axel Cabrol, Head of Fixed Income at TOBAM, and also former Volunteer of the Year at CFA Society France, and Tatjana Puhan, PhD and Deputy CIO at TOBAM. Both will discuss how the changes in the buy-side structure of credit markets due to central bank intervention affects price discovery mechanisms and hence the active management industry. Tatjana, Axel, thank you again for sharing your research and your findings. Tatjana, the floor is yours.
Yes, thank you very much for this introduction. Also welcome from our side. So first of all, I would like to introduce the plan for today. If we go to the agenda, yes, first of all, what I'm going to do is I'm going to motivate a little bit, why it's actually interesting to think about buy-side concentrations in the credit market. And then I'm going to talk a little bit about how the buy-side structure of the corporate bond market looks today. And this is sort of the first step that you need to do to sort of understand, why actually, this topic is really relevant to you and from a risk management point of view, but also generally, from understanding better what happens in bond markets at the moment. And then Axel is going to take over and he's going to talk about, to what extent passive investors have actually contributed to this pattern, of the buy-side structure that we see in the market. And finally, he's also going to talk about, to what extent actually corporate bond ETFs might have limited or might have impacted the possibility of active managers to generate alpha in the corporate bond space. Okay, so let's get it started. So buy-side concentration in ETFs, why is it something that should be interesting to you? So, actually, this is a topic that Axel and myself, we have been discussing this between ourselves for quite some time already, and also with clients. And, in those discussions, what we actually felt was that it's a largely overlooked topic in the investment management industry. And it's really something, that we should be a little bit more outspoken about. And so basically what you could observe is that after the great financial crisis, there have been more and more investors who started to use ETFs in the credit space. So before the great financial crisis was actually not really a topic in credit, but after the GFC, they started to increasingly use ETFs. And the reason was that they were looking for tools of actually introducing liquidity management into their portfolios. And so they sort of made the analogy, with equity ETFs, that are supposed to be these, instruments that you can trade at any point in time, you can get in and out and so on. And so they felt like, it might be a good idea to do the same thing, with credit ETFs, use them as a tool to create liquidity in their portfolio. And even, specialists such as, here I brought you like a short article of ETF.com, you can see on the left upper part of the slide. They are even making this analogy with equity ETFs, and basically they are saying, okay, well, as picking ETF in any other asset class, and what we're trying to convince you of here during our presentation is that this is actually very dangerous. Why? Because in the end of the day, the liquidity of an ETF is always going to depend to a very large extent on the liquidity of its underlying, and obviously, the underlying of a credit ETF will always remain a completely different animal than the underlying of an equity ETF. So this is the first thing. So we have this, this buying of investors of ETFs over time for probably the wrong reasons. And then we also had, other investors coming into these instruments over the last years. And in particular here, I would like to mention the Fed. So, central banks implementing actually their QE programs of corporate bond buying through these passive instruments, is sort of outsourcing at least part of these programs, to companies like BlackRock. And this has contributed further, to actually a huge increase in assets of these ETFs. So 6% of the total US corporate bond market ETFs is actually coming, you know, from those Fed corporate bond buyings. So this is actually like a significant number. And as you can see, you know, as we try to sort of highlight with this little graph from the Financial Times in the on the left bottom side of the slide, over time, what, you know, these moves from investors into ETFs and the Fed and so on has actually triggered is that, you know, there are very few very big elephants in the room now that have piled up a really very large amount of money, and they're pretty much stuck with this. And why? Because on the one hand side, they are kind of buy-side investors because, you know, they are sort of managing this money for the buy side. But on the other hand, they have to track certain indices, so they're stuck with, you know, having to replicate some index portfolio, and so they cannot really move a lot away from that, and so they're pretty much stuck, you know, on the same type of securities, and so that creates actually a situation where, you know, the incentives for the guys who manage, you know, those index tracking instruments become to some extent different, because their job is a different or very different from the job of an insurance company or a big pension fund that manages bonds for matching the liabilities, or, you know, kind of just following the credit risk over time. And so this has contributed actually to a change, you know, in the buy-side structure and also in finally the behavior in the credit market over time. And this is something that we're actually talking about, you know, in these papers, in the paper that we publish, and also in the, you know, sort of the outlets of the paper that we publish in the CFA Institute blog. And so we think, you know, it's actually very relevant to know these things and to think about them and to incorporate them into your daily portfolio and risk management. So if we think about why actually investors started to use ETFs as a tool of liquidity management, we can go to the next slide and we will find the answer. So basically, you know, before the financial crisis, we had traditionally, you know, like market makers who were actually providing liquidity by kind of taking the risk on their books. And this is, you know, what they did also do, you know, like you can see here on this brownish line, this is kind of the inventory that corporate bond dealers had. And, you know, in the first part of the graph, you see that until 2007, you know, it's kind of spiking. And then probably, you know, in one reason also why we had this financial crisis was because these guys, they did take quite a lot of risk, but they also have been very important, by the way, you know, in the financial crisis to provide liquidity. But then, you know, regulation came into the game and said, okay, guys, you know, you kind of play too hard this game, and so we need to regulate certain things here. And so the amount of risk that, you know, these market makers are able to take today is extremely limited. And this is also why you see this brownish line here going down so much over the next years after the financial crisis. And so today it's actually 10 times lower, the inventories that they hold, than it used to be, you know, in 2006 and 2007. But at the same time, you know, we had an environment where actually interest rates were going down, and also, you know, we had a lot of corporate bond buying of central banks and so on and so forth. So it was actually a no-brainer for corporations to issue debt, and hence we had a record boom, you know, in the issuance of new corporate debt. And this made actually the overall nominal outstanding in the corporate bond market explode or really kind of increase substantially. And this is basically this orange line that you can see here in this graph. So the size of the corporate IG, so investment grade and high yield market, increased substantially over those years and reached levels that were almost 4 times higher than they used to be back in 2005 if we compare you know, where we stand end of 2020 to where we stood in 2005. And so we have this big divergence, you know, between, on the one hand side, the largest corporate bond market we've ever seen compared to, you know, a much, much lower level actually of liquidity provisions through traditional channels. And that is, you know, why investors then started to turn to thrive, you know, to find different ways of getting liquidity into their portfolio or managing liquidity in their portfolios. And in particular, obviously, this is, you know, what they're looking for as a management tool for liquidity in market stress times. And as you will see, you know, during the presentation, or we will show you during the presentation, you know, how good of an instrument an ETF is for managing liquidity in your corporate bond portfolio, in particular, you know, in market stress times. So now let's first start and take a look at the buy-side structure of the corporate bond market that is a result, you know, of all of these evolutions over the last few years. So first of all, let me note that it's not so easy actually to get a hand-on, understanding how the buy-side structure looks like, because not necessarily every investor has to report their holdings. So some of them, they, like big insurance companies and so on, they're not necessarily required to do that. And so this is maybe also one reason why people are not so much aware of these facts that we are going to present you. But what we did to sort of come a bit close to to understanding better the buy-side structures, we actually took all the data available in Bloomberg on investment management companies that actually do have to report their holdings, and then we tried to find out who are the guys actually that are holding securities that are in these very broad investment universes of global investment grade and global high yield bonds. And basically on the right hand side, the two pillars on the very right side of this graph, they're actually showing you numbers that are very astonishing. So first of all, we noticed that about 30% of the investment grade universe or securities that we identified, they were held by investment management companies, and about 40% by of the high yield market. And then another thing that we noticed was when we kind of calculated the numbers for how much of these holdings were actually held by how many companies, we found out that roughly 50% of corporate IG and 50% of corporate high yield are held by the top 10 companies of the top 10 investment management companies. So 46 for high yield and 55 for corporate IG, to be precise. And so this means that basically there are very few companies that hold a very big amount of corporate bonds and that are sort of kind of having those stakes in the corporate bond market. But now what we did then to kind of understand even better the buy-side structure of the corporate bond market was that we sort of zoomed into what is actually active asset management and what is actually passive asset management. And here I would like to that you take a look at the second pillar, kind of counting from the left-hand side, because this is basically the ETF space, and it shows you that the top 3 companies of ETF providers, they hold 90% of the AUM that are actually invested in ETFs in the corporate bond space. So the top 3 guys hold 90% of everything. So basically, you have a super, super highly concentrated buy-side structure. And these guys, they all sit on the same positions. And why this is potentially a problem, this is something we are going to discuss now in the next couple of slides. And with this, I'm going to hand over to Axel.
All right, thanks a lot, Tatjana, for this first part of the presentation. I'm going to address in more details the case and the structure behind the ETF success first, and secondly, we're going to try to look at what was the impact of these ETF on the active management side of the industry. But let's start maybe with a quick survey, a quick question about your use or potential use of corporate bond ETF as investors. So to which purpose do you currently use corporate bonds ETF? Is it for tactical asset allocation implementation, strategic asset allocation, beta exposure and liquidity management at fund level, or simply, well, you don't use that kind of instrument? And see how our audience, is accustomed to that kind of instrument, so to speak. Okay. Just have one answer. Okay, thank you. So actually, I'm a bit surprised. I would have called that, thought that the majority of the audience would be a user. But yeah, the majority of those of you guys that use these instruments are using that for beta exposure and liquidity management at fund level. This confirms, so to speak, our analysis that the success of these instruments have been linked to the liquidity issue we got after the crisis and the change in the market structure. So ETF success is, is going along the development of kind of Delta One product development to help credit markets manage exposure in an efficient manner. So let's look at the numbers into more details, maybe. The first step of our analysis was just to simply look at, to take a historical perspective on ETF AUMs and to measure how prevalent they are at the moment by type of strategy. And this is what you can see on this chart. So when we blend all the fixed income, I would say non-govies strategies, so aggregate plus corporate focused strategies, it's around 9%, a bit less than 10% of the overall AUMs of our mutual fund sample were ETFs, mainly from three main providers, as Tatjana explained, so a very concentrated industry. But when you focus on specifically on corporate markets, on high yield on the one hand, you get a higher number, around 12%, and quite an impressive 25% for corporate investment grade product. The reasons for this success, and as you can see, I mean, the growth of this instrument have been quite consistent over the last 10 to 15 years or so, basically accelerating after the great financial crisis. So completely concomitant with the fact that dealers reduced their inventories dedicated to market making, and liquidity in the market was much less relying on dealers' balance sheets. Yeah, well, the reason for this success is basically that ETF are, have some qualities as instruments, I mean, they bring something to the market clearly. The first thing they bring is a really, I would say, an efficient way to replicate some bond indices. And this has real value because most of bond indices are not directly investable for obvious liquidity purposes, but as well, a question of potentially too high diversity, too many instruments in these broad indices. So it was not easy to access kind of index investments in the corporate bond universes. And ETF are doing that, and they are based on replication algorithm. I'm going to get into a bit more details later on, but basically that works fine, I would say. And I'm going to qualify a bit more later on what fine means. And secondly, as they are exchange traded instruments, you have, I would say, unmatched price transparency. The other instruments that can match that kind of level of price transparency and the ability to manage volatility in credits would be CDS indices. But we all know, I mean, all the practitioners of this instrument know that CDS is not the exact same product as the corporate bond. And you have so-called basis risk between CDS and corporate bonds, even at index levels. Sometimes with a huge move in terms of discrepancy between both. So if you want to manage your credit exposure only based on CDS, you're going to have a residual basis risk in your hedging, which is quite often an issue, especially during market stress. So yeah, these instruments are, I would say, here to stay, developed quite strongly over the last years. And most importantly, their main role is really to be a channel for flows into and out of the asset class. And this is what we can see on the next slide. When we just focus on the share of ETF, share of flows, of fund flows attracted, and that goes into or out of ETF instruments. And what you can see on this chart is that for IG, let's start with IG. I mean, this is the ETF footprint is really massive. So over the last 5 years, it was around 50% of inflows targeted to the corporate IG asset class. were going through ETF, but that's pretty much the same for outflows. More recently, over the last 2 years, was more than 40% of outflows. So really, these instruments are the main gates to the IG market. This, I mean, we have the same kind of phenomenon on the high yield side, with around 30% of the flows, of the inflows in high yield that were concentrated in ETF over the last 2 years. Why? Well, outflow, it was mainly during the COVID crisis last year, reaching the same kind of level, and before a bit less than that, like more like 25%. So yeah, these stats really confirm the intuition that these instruments providing price transparency and the ability to quickly manage exposure as Delta One instruments are one of the main tools available now to adjust exposure, to manage exposure. They were actually the first instrument to come, and maybe one of their advantage when compared to CDS, as I've discussed already, but and TRS, which is another instrument out there, is that ETF are available for a very broad base of investors, from retail to pension funds. I mean, everyone can access that kind of instrument, so they are potentially the most universal instrument to manage exposure to credit. But maybe when we look at that, we thought that it's interesting to look into a bit more details on how it works, because what we have is a great success instrument that now account for around I mean, between 25 and 40% of the flows of the asset class. So quite important instruments that are managed by basically 3 companies out there. So highly concentrated in terms of providers, and try to understand how it works and why it is so concentrated and what kind of impact it could have on the market. So let me directly go to the next slide to spend some time on this topic. So yeah, the first point is to have in mind that, as I mentioned already, bond index replication is not as easy as I would say direct, as simple as on the equity side, for instance, or as on the treasury govies side in terms of bond market. There are many reasons for that, but mainly this is linked to liquidity in the credit asset class. And these instruments therefore don't work with a direct replication. And the way it works is that the market makers, so the so-called APs, authorized participants, that are in charge to manage the interface between investors and the asset manager of the fund, are basically managing the flows, and they are able to use small baskets of bonds in order to create and to manage basically flows, inflows or outflows from the funds in kind. So what an AP as a job, an AP market maker really do all day is to compare the valuation of this, I would say, sub-index, very small basket of bonds that he can use or she can use to create shares or destroy shares, and the pricing of the ETF to know how costly it is basically to create new shares or destroy shares if needed. And all I would say, the main aspect of this ETF arbitrage, so you have the arbitrage between the value of the bond basket and the value of the ETF, is of course in the algorithm that identify and builds this basket. Again, as we said, we have out there 3 companies doing and designing this algorithm. So there are pretty much potentially three different ways, but we can imagine that those algorithms tend to be extremely close to each other. So we have basically, one way to manage this bond and this replication algorithm out there. And how it works? Well, it's gonna have to focus the majority of the flows on tradable bonds, meaning that the majority of the basket is going to be comprised of liquid instruments. And if the index to be replicated, has some illiquid bond exposure, it's going to be part of. The baskets are going to be made by a tiny part of those illiquid bonds, but it's always going to be a bit tiny. And most of the tracking error is going to come from this liquidity premium between the basket and the underlying index. So as an illustration, we kind of lucky because we had this major test last year with a huge stress in the market during the COVID crisis. So it was, tempting and easy to look at the liquidity, a measure of how well this replication works during market stress, measuring the difference between the listed ETF closing prices and NAV at the end of the day during 2020. So what you can see on this chart is the maximum discount to NAV. So how discounted were the ETF to the valuation of their underlying bonds of the fund that we got last year. Of course, all of these maximum discounts were reached during March 2020 at the peak of the crisis. And so what we did is just to focus on the largest instrument out there. So looking only at bond ETF listed in the US with more than 1 billion AUM. So we're not trying to look at small instruments. All of these instruments are, I would say, heavily or intensely traded and used instruments. And compare, we split out this sample by the size of discount to NAV, and we compared the max discount observed on the credit side, which is in brown, on the bond side in brown, with the same analysis based on equity ETF. So what you can see is that for the 10% most liquid instruments, there's no real difference between fixed income and equity. And this is logical because fixed income, the most liquid part of fixed income ETF are going to be comprised of treasury and govies ETF. It's not corporate bonds. So a very liquid asset class. And there is virtually no discount to NAV even during market stress for those, I would say, best 10% or most liquid 10%. But then when you go towards the less liquid sub-segments of the bond market, you can see that the difference with equity is getting higher and higher, and that fixed income ETFs appear to be 2 to 5 times less liquid than their equity counterparts by this measure, meaning that the discount you had to accept to pay, so to speak, to trade was between 2 times and 5 times higher on the bond side. And of course, as you can imagine, the less liquid deciles here were ETF invested into EM debt, high yield debt. The less liquid part of the corporate bond market. So this is a confirmation of what Tatjana explained earlier. Of course, these instruments are great in normal times because you get price transparency, you get a great way to adjust quickly exposure, but there is a cost, and this cost, and there is no magic. As the asset class you want to trade is illiquid, so to speak, by essence, you have to pay this cost, and this cost is getting very high during market stress. So ETF are not a solution, so to speak, to alleviate or to reduce materially the liquidity premium in the asset class. Maybe another important point to keep in mind is that, 2 important points to keep in mind about this slide. Is that ETF, during this ETF arbitrage and during that kind of time, had to focus on a specific part of the market. So what these ETF managers were trading at the time, as everyone, I would say, was obviously the most liquid part of the tradable part of the underlying indices. And secondly, is what happened then, because what we're looking at here is a US statistic, and we all know that we had a central bank intervention at the time. So these were, the maximum discount to NAV that were recorded before Fed intervention, and thanks to the Fed intervention, this discount to NAV just disappeared. But this is something to keep in mind. We had to get a regulator, direct intervention to manage this liquidity stress at the time. If we then look at another aspect of ETF, which is maybe more of a concern for long-term investors, this is, I think, this is interesting because it's directly linked to what we just said on liquidity. So ETF, the bonds that are mostly traded by ETF are going to be more liquid than the rest of the market. But we measure that in the US last year, so that you have the stat in mind. The bonds that were traded on average by the HYG during the COVID crisis were had 5 times the average volume of the trace, meaning the overall the overall yield market. So of course, high yield is maybe the most impressive asset class in this respect, but clearly ETF are trading more liquid bonds because they have to manage flows, and concentrating their investment on liquid bonds mean that basically that they shouldn't be the best instruments to collect the liquidity premium in credit, if there is any. And there should be some, because as we just seen, you have a liquidity risk in credit still. So in order to try to measure that impact, we compared long-run Sharpe ratios over the last 10 years, including the 2020 crisis, between the main US ETF instruments and the main, one of the main broad indices, corporate bond broad indices for IG, for US IG and for US IG. So if you look at the two first bars, you see a comparison between the iShares US dollar investment grade corporate bond ETF, the ticker of which is LQD, Sharpe ratio over the last 10 years, and in orange, the light orange, the US corporate IG index from ICE, the Sharpe ratio from the index. So part of the difference in Sharpe ratio, which is around 0.2 times in IG, is of course related to fees, because you have a net return on the ETF side and a gross return, so to speak, on the index side. But fees are accounting for a tiny part of it. So liquidity premium is a good candidate, so to speak, to explain the difference between the two bars. When you look at high yield, it's even more pronounced. The light orange bar is referring to the ICE US high yield index, Sharpe ratio, and the two brown bars in the middle are the HYG, so the main ETF from iShares, and the JNK, which is the main ETF from State Street. Sharpe ratio as well over the same period. These two instruments are the largest US high yield ETF by AUMs out there. And what's interesting, so we have the same phenomenon, lower Sharpe ratio, potentially a higher risk premium, liquidity premium in high yield, which is not shocking news. And yeah, what's interesting is that these two ETFs don't have the same underlying indices. They don't try to replicate the same index. The HYG is trying to replicate what the so-called liquid index, while the JNK is trying to replicate a broad index, which is a Bloomberg Barclays, very similar to what's to the ICE index in the same chart. And you can see that even this replicating algorithm is unable to capture the liquidity premium on this chart. So one of our conclusions from this analysis is that for long-term investors and for strategic allocation, it's not very, a really good idea to use ETF because you're going to miss, as a long-term investor and potentially a liquidity provider as well, you're going to miss the ability to collect the risk premium over time. In addition to that, this is obvious, but I have to say it, these instruments are index replicating instruments. So of course, you're going to have the exact same issues that you would have by investing into passively into an index. An index is weights are made of it's not, the equivalent of market cap for bonds. So the largest issuer or the largest weight is going to be the issuer with the largest debt out there. It's not always the best algorithm to allocate risk. And indices are not that well diversified, and they carry concentration, especially in the US on energy recently. So as a long-term investor, you're going to suffer from both the concentration inherent to indices and passive investment, and this, I would say, illiquidity and negative premium. So this is, in our view, these are the very both the very special role ETF play as a delta one liquid instrument in the market, and why potentially they are not fit for every uses, especially for long-term investment. But the strong success ETF had recently in the market did have some consequences for the active management industry as well. So in order to try to measure that and to put numbers on that, we first tried to compare the risk budget dedicated to credit selection between active funds and ETF funds in our sample. So to do that, we used a PCA analysis. We built the PCA over a very broad number of indices representing pretty much all the factors possible one can think of in the corporate bond markets, and retained the first 5 principal components, and did a regression to see how well these 5 first components were able to capture risk at the fund levels. And what you can see on this chart is we're comparing the R square of this regression. So how well this regression works, basically how well these 5 main market factors are capturing the risk at the fund level, distinguishing between the active funds and the ETF. So active funds are on the left-hand chart. And on each chart, we split out the results by fund sizes. So the first bar chart here is for small funds, less than 200 million in AUM and asset under management. Then 200 to 500 million here, up to, at the end, between 2 and 5 billion for the second to last bar. And the last bar on the right is comprised of funds with more than 5 billion AUMs. And actually, this was a surprise to us because when we did the exact same analysis on the ETF side, what we found is that the residual, so to speak, so for active fund, this is the maximum risk budget dedicated to alpha generation, to credit selection, is very much comparable on the active side for large fund to what's going on the ETF side. So this is quite of a surprise, and that means in our view that there was a convergence toward passive investments. The larger the AUM on the active side, the most passive you get, and clearly investing in very large fund, active fund, is not very different from investing directly in ETF. So it was tempting to see if we find the same kind of results when we try to measure alpha, or at least returns, because this was about risk budget. So let's see what we got when we tried to analyze return. So what we did is we defined alpha first as the difference, the return difference between an active fund and an equivalent portfolio of ETF that would have the exact same exposure to the 5 PCA factors we've identified in our first analysis. This is what we call a replicating ETF portfolio. So alpha, what we call alpha here is really comparing active fund to ETF portfolio. So it's very practical. It's completely investable, I would say, on both legs. And then we used 5 years of returns and computed, the average alpha over 5 years annualized, and split that statistics for each fund by 2020 AUMs of each fund. And this is what you can see on this chart. And the main, I would say, takeaway from this analysis, at least in our view, is that the dispersion, the alpha dispersion you get from very large investment in very large active funds is actually a tiny dispersion, especially on the upside. So, well, it's not a surprise to see that, more or less for pretty much all the sample, picking the right fund and the right active manager is a tough job because it's close to a flip coin probability to generate alpha or not. So you have a 50-50 kind of statistic, whatever the size of the fund actually. But then when you're right and you invest in a very large fund, well, the upside is, I would say, minimal. It's clearly less than 50 bips annualized, so it's not huge. And of course, you have pretty much the same downside as for small funds. So if fund selection and manager selection clearly can add value for, I would say, less than 1 billion strategies in corporate bonds, it doesn't really make sense for large funds. This is, I would say, a confirmation of a well-known result about alpha, meaning that alpha generation in the traditional sense is not supposed to be scalable. This is linked to the Grossman-Stiglitz paradox, meaning that, okay, if you think, if you want efficient markets, you need people in this market to identify mispricing and to trade on that, so that mispricing, are just going out of the market. But as these people are doing this job, so active managers basically are doing their job, while the alpha opportunity is going to disappear in the market, and their job is going to come tougher and tougher. And basically, this issue about unscalability is confirmed in corporate bond markets for very large AUM. This is a real issue for the industry because ETF are, representing a significant amount of the AUM at the moment. They are managed by 3 players. So that means there is a pressure on costs. That means that this concentration on the passive side is going to push for concentration on the active side, and this is what we saw as well. So the numbers are less impressive, but you have the top 5 asset managers firm in our universe amounting to like 40% of the AUM, so on the active side, so it's significant. And alpha generation is, in the traditional sense of the security by security mispricing identification, it appears not to be scalable. Well, it's not very good news for long-term investors, but actually it's even worse than that. So we looked a bit deeper in the alpha statistics, looking at how it's evolved across time. Because, well, in essence, alpha should be uncorrelated across active managers and across time. At least this is what you would expect, statistically speaking. So, for an investor and an asset owner, it makes sense to diversify its allocation to many active managers and to expect to get some return on improved Sharpe ratio or information ratio from this alpha diversification. Well, actually, it's not clear it's going to be the case. Why is that? Well, simply because when you look at alpha generation by active funds in the corporate bond market, in the same sense, so alpha meaning the difference between active fund management and an equivalent ETF bond portfolio, you can see that we have kind of a pattern, you know, with alpha generation being good for everyone at the same time. With the main illustration of that was 2018 and 2019. In 2018, we had more than 75% of the funds in our analysis underperforming their ETF equivalent. While in 2019, it was the exact opposite. 75% of the sample outperformed, and sometimes outperformed significantly the ETF equivalent. So this, we don't have a definite explanation on why we can observe that kind of pattern in alpha generation. But one natural candidate for that would be liquidity. So we saw that ETF are not really fit to capture the liquidity premium over time. So potentially we had a liquidity related issue at the time. And indeed, at the end of 2019, we had some volatility in the market. So potentially this was linked to that. So we ran the analysis, splitting out more liquid funds from illiquid ones, using autocorrelation of weekly return as an indicator for potential illiquidity of the underlying investments. And it does account for a part of it, but far from explaining the full picture of the discrepancy. So it's always as well very possible or probable that there is kind of a herd behavior in anticipation in the active management industry. So all in all, it's a dim picture for the active manager, the comparison between the ETF and the active management proposition, because well, first you have a scalability issue, you have cost pressure, and potentially the ability to deliver alpha consistently is far from being proven, and your investors don't benefit from a real diversification phenomenon at alpha level. So what are the main takeaways in our view from this analysis? The first one is that clearly the ETF, the low-cost competition from the ETF side, had a real impact on the industry, and the race for scale, or the need for scale, is going to stay with us, at least in our view. Secondly, it's pretty clear that the price discovery mechanism with ETF footprint in the market, growing and growing, could lose in efficiency because we're going to have less active manager dedicating risk to that, because it's less, you're going to get less return from it, and you're going to have ETF investing without taking care and paying attention basically to that. For long-term investors, you have active manager. You have an issue because selecting an active manager is getting more and more difficult, because as we saw, large fund, the largest fund, are not really fit to deliver alpha. And if you want to properly collect the risk premium and the asset class premium over the long run, you're going to have to focus, to pick the right manager, in the small kind of small AUM class, which is clearly a tougher job to do. And lastly, and this is our conclusion at TOBAM, we think that this really talk well about quantitative and smart beta approach to and quantitative portfolio construction approaches to corporate bond investment. Why is that? Because one solution on which quant-driven credit investing is based on is simply to change the perspective. Instead of looking for mispricing at each securities level, we're going to look at risk premia. So we're going to look at designing portfolio that are going and able to deliver over the long run the real beta of the asset class. And beyond that, I think, and I hope you're convinced on that, that ETF are not really well fit to do that job. First, because of their inability to collect the liquidity premium, and secondly, because of this huge concentration and this very passive way of allocating risk in the market that is not well designed to collect the full risk premium available in credit. And that would be my conclusion. So I don't know if we had any question coming in. I don't see that.
So I do have a question that came in through me. Let me just read it to you. So do you think the Fed intervention via ETF instruments affected the market structure?
Axel, do you want, or should I take it?
As you wish. I can take it. I mean, okay.
Right.
Well, okay. So I go ahead. Okay. Yeah. Clearly, I think so. I think this was a game changer. I mean, in two aspects. The first one is that clearly the usual channel, monetary policy channel, meaning banks, meaning dealers, is not efficient anymore to manage credit market liquidity. So that's the first conclusion, and I think we could all agree on from what happened last year. And secondly, well, if investors start to think that they did it once, so they can do it again, which is a fair assumption, we might have a real change in the way liquidity premium is priced in the market going forward. Because now, I mean, you can think that you have a lender of last resort for corporate bond, at least in IG, yeah, with central bank intervention, so to speak, giving a floor to the maximum stress we can get in terms of liquidity in our market. So yeah, I think it's both a confirmation that the market structure has changed, and the role of dealers has completely changed. First and foremost, potentially, and secondly, that ETF, at least central bankers are going to look at those instruments in the future to assess, potential liquidity stress and potentially to manage it directly.
Thanks, Axel. Do we have any other question? Feel free to drop any questions or comments in the chat, or you can also raise your hand and ask your question directly to our callers. Okay, so we have one coming in. Could you give us an example of instruments you are using and how at TOBAM to adjust different risks without affecting your core portfolio, such as index derivatives, index tranches, or other?
Very good question. The first thing is that what we do at TOBAM is we try to deliver, a better beta to for our investors. So this is what we aim at, and that means that we don't provide any market timing kind of ability or that kind of thing. So my point here is that exposure management at our fund level is really about liquidity management, basically ensuring that we can ensure daily liquidity in our product much more than anything else. And we try to reduce the use of any Delta One product we could use at the minimum, because we think that, well, in the long run, these instruments are costly to use. In terms of the instruments we can use, they are very basic instruments, ETF, of course, CDS indices as well. TRS we can, but we have not used that so far, and we plan to do that. We don't do any tranches and things like that. mainly because our strategy are, very simple delta one kind of strategies, and this is what we're focusing on.
Thank you, Axel. So we are running out of time. So thank you all for connecting this evening. Feel free to email us if you have any additional questions, and we'll be sure to pass them along. The replay will be available in the coming days on our YouTube channel, and you'll of course get an email with the link. So thank you all for connecting, and have a lovely evening.
Thank you. Bye-bye.
Thank you. Bye.